Hello guys, I hope you guys are well. Welcome to the final segment on the general partner investor perspective in the investment process. I hope you guys are enjoying this because I am. Yeah, so this final segment is just practice questions. It's important that you practice. You learn, you practice, you improve, and you practice again until you master it. So let's get right into this. This shouldn't take us too much time. I'll be giving you high-level points on how you answer these questions. Keep your answers straight and to the point. All right, so with regards to these vignette-style questions, I suggested you first read the question and go back and read the passage to see what you require from the passage to answer the question. Pause the video and do that. All right, with the first one, evaluate the accuracy of Du Bois' statement 1. So what's important, you can read through to get background on this, but what is important is going to be this part here, statement number 1. That's what they want you to answer on. All right, so but the background is important as well. Estragon SA is a growing French venture capital firm with 5 completed funds, with another fund nearing 100% capital deployment and in planning stages for its 7th fund. As a result, its success and growing capital base for each successive fund, the firm is seeking to hire a new associate. Susan Du Bois, senior partner of Estragon, is interviewing several candidates for the position. To introduce candidates to the free fee structure of the firm's fund, Du Bois makes the following statement to the job candidates to start a conversation. So this is the statement that we want to evaluate. The firm's management fees are typically 2% of the firm's valuation of total fund stakes in portfolio companies. The first part of this statement is true, 2%. Remember, this is a venture capital, and we said that in private equity, the management fees are roughly 2%. And in private debt, the management fees are roughly 1%. So 2% on average is okay. So this first part is going to be correct. The second part is that the firm's valuation of total fund stakes in portfolio companies of the firm's valuation. This is not correct. This amount is going to be on the committed capital. This amount is going to be on committed capital. Okay, so what usually happens is that the GP is going to get 2% of the committed capital. Initially, when the capital has been deployed, during the capital deployment stages, the management fee, the GP is going to get this 2% multiplied by the committed capital. I'm going to use CC for committed capital. And following, this is during the capital deployment phase. And after the capital has been deployed, the return to the GP after this capital deployment phase is going to be 2% again, but of the committed capital minus any cost basis, and exit in periods after the capital deployment. This is how the management fees are going to be calculated. They do not calculate 2% of firm's valuation, because if they did this, it would give the GPs an incentive to inflate their valuations. And if they inflate their valuations, they're going to pay them more than what they're supposed to actually pay them. They're supposed to be paid. So number 1, first part is not correct. Is correct. Second part is not correct. 2% of committed, not of the firm's valuation. Number 2, discuss Estragon's possible approach to setting carried interest terms with continuing investors and new investors. So you have to distinguish between these two to get full marks. There are 2 points that are made here. This GP is highly successful. The capital base is growing. So it means they have a strong performance record. They have a strong performance record, number one. And the second point is that the fund is highly sought after. The capital base is growing. Because of these 2 points, they have high bargaining power. They have high bargaining power. Because of they have high bargaining power, the GP can set its terms to the investors. So it's likely that they are going to set terms which are going to benefit the GP. And then now you make a distinction between these two, continuing investors and new investors. The terms are going to be more generous on the continuing investors because they've come far with them. So they'll be more generous or more understanding of the continuing investors. But new investors or investors that are going to join later on, they are going to be less generous terms here. They're going to be less generous on the new investors that come later on. Okay, so that's what your answers should be straight and to the point. Number 3, which one of the following statements most accurately described a reason for LPs to desire a clawback provision in carried interest terms? So for carried interest terms, you'd want to you're going to benefit if a fund does well and then fails to do well later on. Answer B is the correct answer. A clawback provision protects LPs from overpaying performance fees when early funds are exited successfully, followed by much less successful investments. We did an example on this, but if you didn't do it, it was a fund in which in the early years, this fund made a lot of money, maybe 360 million in the early years. Then subsequently, this is the first year, in the years 2, 3, and 4, they made 0, 0, 0. And for this time, they had made 25 million. So the GPs had already collected their fees, 25 million. But because of these subsequent failures, there was a clause that there was a header that said that they should not get anything that exceeds 19 million, which means they had to pay back 6 million. And it benefits the LPs in that case. So B is correct. Number 4, identify and briefly discuss the most likely investment strategy used by Estragon. Estragon is a venture capital, and these venture capitals have very high failure rate. The failure rate is quite high. High failure rate. And because of this, the exit strategy that is most likely going to be used is going to be either liquidation or private sell at a loss, because of the high degree of failure of venture capital firms. Okay, so this answers the first case study, and on a high level, this is what is expected of you. Now, the second part, questions 5 to question 8. Again, you read the question, explain the 2-part sequence of financing for Bardstown's purchase of E&F grocery. What is Bardstown? What is E&F? Bardstown Partners is a global private equity firm based in the United States with the focus on tech private transactions. Jack Spear is a managing director at Bardstown and specializes in deals in consumer-oriented businesses. His most recent investment transaction for Bardstown was 1.5 million purchase of E&F grocery financed with 900 million of debt. So there are a couple of things that you need to consider here. This grocery E&F grocery store was financed at 1.5 billion, but they used 900 debt. If it was 9 billion, if it was 1.5 billion euros, what it means is 900 million is given as debt. Where does the other money come from to get 1.5 billion? means 600 million is equity. Okay. So the two parts are going to be part one. What they do is that Bardstown is going to contribute 600 million euros in its equity. Once it has contributed 600 million in the form of equity, they use this 600 million to acquire a new business entity. So they acquire a new business entity, and we refer to this as acquisition company. So we refer to this as acquisition company, CO. After which, when they have this acquisition company, they then arrange 9 million for short-term financing. So they now arrange 500 million euros for short-term financing. Okay, and then this 500 million for short-term financing is then used to purchase E&F. This is used to purchase E&F. And remember, E&F has been our target. So E&F is what we are going to refer to as target company. Okay. So this is the first part. And then in the second part, part 2, acquisition company and target company are merged. So your acquisition company and target company, E&F, are going to be merged. They are going to be merged, right? And once these are merged, they are combined into a business to form a new entity. And this new entity is then used to pursue long-term debt. Okay? And this long-term debt is going to be for 900 million euros. This long-term debt is going to be used then to refinance. It's then going to be used to refinance the short-term debt of 900 million. And then this gives us the two parts in which the two-part sequence of financing for Bardstown's purchase of the acquisition company, of the target company E&F Grocery. Okay, so that's how you solve that. And then the question number 6, which one of the target companies is likely the best opportunity for take private transaction? You have to read all of them, all three of them, to see which one is the best one. 1, 2, 3. Read them carefully. And you need to take note of this. For a take private transaction, eligible companies usually have two characteristics. Number 1, they must be facing a lagging performance. They must be facing a lagging performance. Like what my pen is doing now. I don't know why my pen is lagging. But they must be facing a lagging performance. That's 1. Number 2, they must have management issues. They must have management issues. And if you look here, number 1, returns on capital over the last 3 years below industry average. So this is a lag, which is fine. And a CEO with majority ownership of the company. If the CEO has a majority share ownership of the company, it might be a problem because this CEO would push to sell the firm at a higher value. So we cancel that. Number 2, returns on capital over the last 3 years below average. This is a lagging performance. And a significant senior management turnover. Managers are leaving, so it's a problem also. So we have management issues. Good. Answer is 2. We need to not go further than this, but you can. Returns on capital over the last 3 years above average. So this is not lagging. And strong management team. So option number 2 becomes the target. So B is the correct answer for this one. Then we continue with this case study. Which one of the following categories for value creation sources is Bardstown least likely to pursue in its transformation plan? So to transform, you need to remember this. We spoke about value creation strategies, right? And we said there are 4 of them. There are 4 of them. Okay, it was 4 of them. We had strategic, value creation, and we had operational. We had organizational, and the other one was financial. Okay, for you to be able to remember this, for strategic, you can use the acronyms SPAR. You can use the acronyms SPAR. Okay, which means in this instance, sell, pursue, acquire, and then for operation now you can use TIMIO, and then this TIMIO is going to stand for target, maximize, increase, and optimize. And organizational, you can use RE, where you have replace, restructure, and establish. Okay, and then for financial, you can use IOM, where your I is improve, O is optimize, and M is manage. Okay, this should help you remember this in a way. For instance, organizational, RRE, for you can put a phrase in your head, somewhere in your head, which says renew, reshape, execute. Renew, reshape, execute. So this all aligns with replacing, restructuring, and establishing. So organizational, you renew, you reshape, and then you execute. On the operational one, you can, to remember TIMIO should be easy to remember, but operational, you can think of tweak my inner operations. Tweak my inner operations. That's the operational one. Tweak my inner operations. Okay, you want to optimize, you want to maximize your efficiency. With the financial one, to remember this, you can say in our money. This is more about money. Finance is money. So in our money, what you want to do is to improve your balance sheets, improve your cash flows, improve your working capital, and so forth. So you want to optimize cash flows. So this financial, you can say in our money. This should also help you remember. And then strategic, SPAR, should be easy. Sell, pursue, acquire. Anyway, let's go back to the question. I hope this will help you remember in a way. So which of the following categories of value creation sources is least likely to pursue? So which one is going to be least likely to pursue? And our answer in this case, because Batso negotiated 900 million purchase of Target 2 is a new fund investment. As part of its plans to transform the company, it plans to sell one non-core division of the company, focus on improving labor efficiency, and use one or more technology in the company's retail. So because of this, the one that they are least likely to pursue is going to be the organizational one. They're going to improve their operational efficiencies, right? Because they want to optimize. They can optimize by improving labor efficiency. Okay, and in terms of strategic, they can sell, pursue, and acquire. So they are doing this by sell here. They are selling one core division. So strategic is there by selling. Labor efficiency is going to be there, operational. So what they're not doing is organizational. That's the least likely. So answer is going to be B. Number 8, discuss one potential area of concern related to taxation that Bardstown would want to research before proceeding with any plans for moving from the United States. Okay, so during the recent Bardstown Investment Committee meeting, a discussion about the possibility of moving the partnership's location occurred. Increasingly, Bardstown is finding a greater proportion of its investment in Europe, and as a result, one senior office employees reside in Europe. However, all partners reside in the United States. One important aspect that they should consider is going to be the treatment of carried tax. So this is important. Carried interest. How is carried interest taxed? So the taxing of carried interest is going to be a very important consideration before they move from the US to Europe, for example. So they consider how it's taxed and where they get more tax benefits. Then the last and final part here, you read through, and then which of the following most likely describes the capital drawdown during initial 2-year capital deployment phase of Osia Struck's Bangkok residential project? Okay. Asia Struct is a private. Some of these words are difficult for me to pronounce. Asia Struct is a private real estate firm based in Singapore. Its latest fund recently purchased a parcel of land in Thailand outside Bangkok for 600 million, on which it plans to construct a residential development with planned completion in 2 years. The expected total cost of the development is 54 million to be drawn down from both debt and equity sources over the next 24 months, which is 2 years. Okay, so which is most likely describes the capital drawdown? Drawdown is contingent on meeting defined project milestones. So A is correct. This is correct. Number 10, identify 3 goals that Asia Struck would ideally aim to achieve as part of the value creation process of the Bangkok project. So the milestones would be completion on time. They want to complete this on schedule, which is 2 years. They ensure that they have people to occupy the buildings and occupy the units. So you want to ensure occupants of the buildings at the rates that they targeted, and you also want to ensure occupancy of the units at the rent that they've targeted. So those are the targets that they wish to complete. They must complete on time, on schedule, and they targeted greater than or equals to the targeted price, greater than or equal to the targeted rentals. Okay. Number 11, let's quickly look at 11. Which of the following is closest to the LP's annual expected rate of return over the 10-year cycle? Let's go to what the LPs want. Asia Struck's investors are primarily pension plans, sovereign wealth funds, and ultra-high net worth investors who commit capital to the fund as limited partners at the beginning of the fund's life of about 10 years. So the fund's life is 10 years. And these investors are attracted to the returns that are up to 400 basis points greater than typical returns on liquid public real estate such as REITs, which expect to yield approximately 6% per annum. So here's the thing. If the return is going to be 6%, right? But they are expecting, the investors are attracted to up to 400 greater than this 6%. What this basically means is that the return they're hoping to get is going to be 6% plus 400 basis points. 400 basis points are the same as 4% because the basis points are just, one basis point is 0.01%, something that you know very well, which means they expect a return of 10%. Okay. So if they are getting 400 basis points, but however, the Asia's tax capital deployment phase usually lasts for 4 years, and the typical lag between commitment and deployment is 2 years. There are 2 years in which the money might not be committed. So you have this 400, right? And it's over 404% over 10 years. You are going to have the 4% divided by 10 years, and you get 0.4%. The capital is held for 2 years without anything happening to it. So for 2 years, the return is going to be 0.4 times 2, which is 0.8%. So you take the expected return of 10%, then you subtract 2 years where the money is not doing anything, 0.8, and then you get 9.2%. Option number B. Okay. And then number 12, discuss one important exit strategy difference between private real estate and private build, operate, transfer infrastructure investments. Okay. So the exit strategy for the private real estate, right? This might not be agreed upon at the start of the project, but this is definitely agreed upon at the start of the project through a concession agreement. And when it's exited at zero terminal value to the concession grantor under the terms which are pre-agreed at the start of the contract. The terms have to be pre-agreed. So that's the difference between the exit for private equity and private real estate and private build, operate, and transfer. Okay, so that marks the end of this section. Thank you guys for your patience and your willingness and ability to learn. Thank you. Cheers. I'll see you guys in the next session where we are going to be discussing. This looks like a sad face. Should be smiling. Let's see. Yes. I'll see you guys in the next session where we'll be discussing private equity, which is the most dominant form actually of private market investments. So this is it for me for now. I'll see you guys in the next one.